Welcome back to the deep dive. So, picture this scenario, something I think a lot of manufacturing leaders run into. You look out onto the factory floor, everything seems, well, green. Production targets are hit, output's high, customers seem happy. But then you look at the balance sheet, and the profits just feel, I don't know, thinner than you expected, mysteriously low almost.
Yeah, that feeling, that gap between seeing success and actually banking the cash, that's almost always revenue leakage waving hello. It's the money you technically earned from what you produced, but it somehow slipped through the cracks before hitting your account. It's an internal failure. Think of it like paying for a full tank of gas, but maybe the pump gauge is off or there's a leak you don't see and you only get 98%.
Oh, okay.
That missing 2%. It's silent. It just erodes your earnings without raising alarms.
And our sources are pretty clear. This makes it one of the, well, the most dangerous financial blind spots out there, especially in manufacturing today. So our mission today is to really unpack how these internal leaks happen, where they hide, and then introduce the strategic solution to, well, plug them up proactively. And that solution revolves around something called smart accounting.
Right. Let's maybe start with a clearer definition. We hear about market losses all the time, external stuff, price shifts, currency issues. But revenue leakage is different, isn't it? Why is that distinction so important for managers to grasp?
It's absolutely crucial because these internal leaks, these are the losses you can actually control. Revenue leakage is essentially potential income that vanishes because it wasn't properly billed or recorded or maybe even collected. It comes purely from small inefficiencies, operational waste that goes unnoticed, or often gaps in data between, say, your production systems and your finance systems. It's a process breakdown or a tech issue, not the market hitting you. Okay, that makes sense. And when you look specifically at manufacturing, which is often complex, where do these hidden drains typically lurk?
Oh, they can be everywhere. The product sort of changes hands or crosses a data boundary. A really big one is unbilled or underbilled output. You might make 1,000 widgets, but maybe the data doesn't match up perfectly between the shop floor count and what logistics says shipped.
So only 950 get invoiced.
Exactly. That 50-unit gap, that's pure lost revenue. Leakage.
And the finance team might never even know those 50 units actually shipped because the data just isn't connected.
Precisely. Then you've got operational waste. Think wasted raw materials, scrap from production, rework on faulty parts. Often these costs get bundled into general overhead accounts or variance buckets.
Which hides the real cost, right?
Completely. It hides the true cost of making that specific batch and masks the inefficiency. If you're not capturing the cost of that wasted material right away, your profit calculation for that job is just plain wrong.
And moving away from the factory floor stuff,
Yeah.
there's the admin side too, right? Contracts and compliance.
Yes, and honestly, this is often where the biggest shocks are found. Ignored contract terms are a massive source. Think about missed price escalations agreed with long-term customers. Maybe the contract says the price goes up 3% on January 1st.
But the billing system never gets updated.
Exactly. Or it gets updated late. That 3% is just gone forever for that period. Or conversely, maybe you fail to claim penalties you're owed from suppliers for late deliveries or quality problems.
Ah, I see. It cuts both ways.
It does. And then there's the sort of universal culprit, disconnected data silos. This is just systems not talking to each other effectively. Inventory management, your CRM, your ERP. If they're not integrated, you get misreporting, misbilling chances, all sorts of issues.
It's interesting because we talk about these small errors, 1% here, 2% there. It sounds almost trivial. But the sources really hammer home the financial impact. That 1% or 2%, when you multiply it across every production line, every customer contract, it quickly scales up into millions in lost revenue each year, right? And often goes totally unnoticed.
Yes, unnoticed until maybe there's a serious cash flow crisis, and then you have to bring in expensive auditors to figure out what went wrong months or years ago.
That delay in realizing it is the real danger.
It is, because the cost just gets absorbed somewhere, maybe hidden in cost variance. The system isn't flagging it as a problem, so the business thinks its margins are, say, 10%, but in reality, they're maybe only 8%. You're bleeding cash, but the reports look okay because the loss is buried.
Okay, so clearly we need to shift away from that reactive mode, just cleaning up last quarter's errors, towards something more proactive, more strategic. Let's bring in smart accounting. If this is the strategic shield, what's the underlying technology? What makes this shift possible?
Well, the foundation really is the Accounting Information System, or AIS. We should probably define that up front because smart accounting doesn't happen in a vacuum. And AIS is basically the software framework. You could think of it as the central nervous system that collects, stores, and processes all the relevant financial and operational data. Its whole purpose is to support decision-making, auditing, reporting. It takes data from the shop floor, the warehouse, sales, everywhere, and puts it into a useful financial context.
Got it. So the AIS is the structure, the plumbing, and smart accounting is the strategy that uses that structure. It's moving beyond just like digital bookkeeping into this proactive financial intelligence system. It blends automation, analytics, and crucially, that seamless data integration you mentioned.
Exactly right. We're shifting the focus from just recording history to actively safeguarding future earnings. It's proactive revenue assurance. What's really powerful is how it can immediately link production data, inventory levels, and financial records into one coherent picture, one ecosystem. And critically, it captures the actual costs of production materials used, machine hours down to the minute, labor input automatically, and in real time.
Okay, hold on. Unifying production, inventory, finance. I mean, isn't that the holy grail manufacturers have been chasing with software for decades? How realistic is that kind of seamless integration for, say, a mid-sized factory that might have legacy systems, different vendors? Sounds expensive and incredibly complex.
That's a really fair point, and yes, the complexity is real. But the
Yeah.
technology has evolved significantly. We're not necessarily talking about a massive rip and replace of everything overnight. Smart accounting often relies on things like middleware and APIs, application programming interfaces. These act like connective tissue. They help existing systems, your ERP, your MES, manufacturing execution system, your financial ledger, talk to each other.
So bridging the gaps rather than replacing everything.
Exactly. It's about creating shared understanding, shared data dictionaries. So when the MES logs 100 units completed, the AIS instantly knows that means update inventory and flag for potential invoicing. Honestly, the return on investment from recovering leakage usually justifies the integration cost pretty quickly.
Okay, that makes more sense.
Yeah.
The cost of doing nothing, of letting the leaks continue, is actually higher than the cost of integration. So assuming this data ecosystem is set up, how does smart accounting then proactively tackle those four big leakage areas we identified? Production, inventory, accounting, and contracts.
Right, we can map specific tech solutions to those areas. There are essentially three core approaches.
Okay, let's start with maybe the biggest sorts of human error and delays. Accounting and billing.
Okay, solution one is automated core financial workflows. This hits manual entry and delays head on. We're talking automated billing and invoicing. The key is that invoices get generated instantly from verified production data. So if a sensor on the final packing line scans 50 finished items going into a box for customer X.
Boom, the system flags those 50 for invoicing based on customer X's contract terms, which are also in the system.
Precisely. The benefit is much faster cash flow, obviously, and way fewer disputes from customers arguing about quantities or prices based on manual errors.
Makes sense. Okay, next big challenge. Those disconnected data silos, which really mess up production and inventory management, right? Ensuring reported costs match reality.
Yep. That brings us to solution two, real-time data and analytics integration. This is where we properly link the ERP production systems like MES and accounting platforms into a single unified view. The application here is kind of twofold. First, you get live dashboards tracking cost deviations.
So a manager can see right now if the current batch is costing 10% more in materials than planned, while it's still running.
Exactly, allowing for immediate intervention. But second, and maybe more crucial for leakage, the system constantly compares physical output data against invoiced amounts in real time. So if you produced 1,000 parts today, but only 950 have been matched to an invoice or shipment record?
It flags that discrepancy immediately. That 50-unit potential leak doesn't get lost.
Correct. It eliminates that specific type of hidden loss.
And I imagine the instant visibility is huge for controlling scrap and rework costs in production, too. You see the real cost of a mistake right away, not 3 months later.
Absolutely. The immediacy changes behavior. Okay, finally, let's talk contracts and compliance, and also those really subtle anomalies, the ones that are almost impossible for a human to spot consistently across thousands of transactions. This is where solution 3 comes in, AI-powered financial intelligence. This is, frankly, the game changer for tackling sophisticated leakage.
Yeah.
It goes beyond just simple rule-based flagging. It starts auditing behavior and patterns, not just static numbers.
Auditing behavior, how does that work?
Well, we use machine learning algorithms. They can flag things like abnormal discount patterns given by a certain salesperson or repeated billing mistakes going to the same customer, which might indicate a deeper process failure. It can also predict high-risk areas, maybe jobs that frequently require rework, or product lines with consistently low margins suggesting costing errors.
And for contracts and compliance.
The AI automates the tracking. It ensures that 3% price escalation is applied on the correct date. It can alert you, say, 6 months before a major supplier contract expires, giving you ample time to renegotiate rather than missing a deadline.
That point about auditing behavior is really interesting, like your example. If one specific manager keeps approving, say, a 20% discount on orders over a certain value, the AI doesn't just see the discount, it sees the pattern and flags it as maybe needing review. A potential control weakness, not just a one-off.
Exactly right. The AI essentially acts like a tireless 24/7 internal audit team looking for those subtle deviations.
Okay, let's pivot slightly. The technology sounds powerful, but tech alone isn't enough. What are the crucial non-tech best practices? How do you make this work culturally and process-wise? Who owns it?
That's often the biggest hurdle, honestly. It's cultural change. You need to get the production manager to see that tracking machine idle time isn't about blaming them. It's about finding hidden margin they can recover. So best practices really start with that system integration piece we discussed, linking everything to kill data duplication and underbilling. Then enabling real-time cost tracking, capturing all material, labor, overhead costs as they happen. And absolutely critical, building contract intelligence. This means actively managing pricing rules, renewal dates, penalty clauses, ideally automatically within the system.
And alongside that, enforcing tight approval controls, right? Making sure those discounts or overrides we talked about have to go through a proper, maybe automated verification workflow.
Precisely. No more loopholes. Now, to see the real impact, the source material gives a great example. A mid-sized component manufacturer. They were facing that classic problem steady output, but revenue was slowly declining, cash flow felt tight. Their internal audit found, well, what did it find?
Yeah, their problems mapped exactly to those 4 leakage areas. They discovered about 5% of their total production wasn't being billed because of system mismatches. Big one. Plus, their scrap and rework costs weren't being properly allocated in their profitability reports, so they didn't realize how much certain jobs were really costing.
Yeah.
And they were losing money hand over fist through missed price escalation clauses in their customer contracts and also failing to claim penalties from suppliers. Profitable on paper, but cash was tight.
Classic symptoms. And the results after they implemented a smart accounting framework. They integrated their old ERP with new automated invoicing tools and some AI analytics. What happened? The results were pretty dramatic. Within just 6 months, they recovered 6% of previously unbilled revenue. 6%. They slashed billing errors by 80%. And overall, their profit margins improved by 12%.
Recovering 6% of revenue in half a year? That's huge. It really shows these aren't just theoretical losses. It's real, recoverable money sitting there. And this success, as you said earlier, it relies on having that solid accounting information system, AIS foundation. The ROI from a good AIS seems pretty clear across the board.
Oh, absolutely. We're seeing manufacturers report things like improvements in financial accuracy up to 90%, reducing the time it takes to close the books each month by 50, even 70% sometimes, and getting paid faster because invoices are accurate and go out on time. That directly boosts cash flow management.
So wrapping this up for you, the listener, what's the big takeaway? Revenue leakage, it seems, isn't just an accounting headache. It's really a fundamental operational issue, isn't it?
It absolutely is. It's as much about operations as finance. Smart accounting provides that bridge. It gives you financial agility and operational control working together. That's the key to improving and sustaining profit margins.
Okay, so if you're listening and thinking, where do I even begin with this? The implementation roadmap offers some clear first steps.
Yeah, 3 immediate actions. First, you really need to do an internal audit. Find out where manual processes or those system gaps are currently causing losses. Be honest about it. Second, you have to aggressively map your data flows. Trace how information moves, or doesn't move, from production output all the way through to invoicing and payment. Close those gaps.
Makes sense. And third,
You need to assign a revenue guardian. This means making someone or a specific team explicitly responsible for revenue assurance.
so it becomes a proactive role, not just reactive cleanup.
Exactly. It makes financial control part of someone's core job, ensuring these leaks are constantly being monitored and plugged.
This whole shift,
Yeah.
tying every production step, every cost, every contract term back to an immediate financial insight. It must completely change how you look at efficiency on the factory floor.
It really does. It forces a much sharper focus.
Which brings us to our final provocative thought for you to consider. If every production step can be tied to financial insight, what specific, maybe currently unrecorded operational metric in your business, something that seems minor now, like, I don't know, the exact time spent handling small amounts of scrap or the log downtime for a seemingly non-critical machine, could that be the next million-dollar leak just waiting to be found, waiting to be protected by this kind of financial intelligence?
That small ignored detail. It might just be sitting on a surprising amount of hidden profit recovery potential right now, something to think about.